Welcome to the Deep Dive. Today we're digging into an article from The Motley Fool. Came out just yesterday, April 23rd.
Right. The headline grabbed me too. Something about dividend stocks being bargains.
Exactly. Got 10 years and $1,000, 3 dividend stocks that are high-yield bargains. So our plan is to unpack the 3 companies they mention: Carey, Chevron, and PepsiCo.
Sounds good. Figure out why these specific ones, especially for that long-term 10-year view.
Okay, let's jump in. First up, Carey. Now, the article points out, maybe a bit controversially for income folks, that they actually adjusted their dividend in 2024.
Yeah, they did. And normally you see a dividend cut or adjustment and think, trouble.
Right, raises a flag. But what was the story there? Why the change?
Well, it was tied to a pretty big strategic shift. They decided to completely exit the office property business.
Office properties. How much of their business was that?
It was significant, around 16% of their rental income, according to the article, so not insignificant.
Okay, 16%. So getting out of that was the trigger for the dividend reset.
Exactly. The idea, as the article presents it, was to sort of prune the portfolio, strengthen their focus on warehouse, industrial, and retail properties. Those are their core areas now.
And Carey is a REIT,
Yeah.
right? Real Estate Investment Trust.
Correct. They own and operate income-generating real estate. So portfolio makeup is key.
So maybe less a sign of weakness and more a strategic pivot, because the next point is actually quite positive.
What's that?
It says after that reset, the dividend started increasing again. Quarterly increases resumed.
Okay, that is encouraging. It suggests the underlying business, post-office exit, is performing well. They got back on track quickly.
Shows some operational strength, doesn't it? And commitment to shareholders, even after a reset.
Definitely. It signals that maybe the remaining portfolio, the warehouse, industrial, retail stuff, is throwing off enough cash.
Speaking of cash, they got money from selling those office buildings, right? What's happening with that?
Yeah, that's the other key piece. They raised capital throughout 2024 from those sales.
How to put it to work.
Exactly. They've been reinvesting it, buying new properties in those focus sectors, warehouse, industrial, retail.
So new assets coming online.
Right. And because a lot of that buying happened later in 2024, the article suggests we should see the real benefits, top and bottom line, start showing up more clearly this year in 2025.
Okay, so a potential growth catalyst kicking in now. And what about the actual yield? The article calls it lofty.
Yeah, 5.8%. That's the current figure mentioned.
5.8%. How does that stack up against other REITs?
Oh, the article compares it to the average REIT yield, which it says is around 4%. So 5.8% is significantly higher.
So nearly 2 percentage points above average. That's quite a premium.
It is. Suggests the market might still be a little cautious after the reset, or maybe just hasn't fully priced in the potential from the reinvestment yet.
Okay, so to sum up Carey. Strategic shift out of offices, temporary dividend adjustment, but a quick return to increases, reinvesting capital for future growth, and a yield well above the REIT average.
That captures it pretty well. An above-average yield, potentially growing, backed by what they hope is a stronger, more focused portfolio.
All right, let's shift gears from real estate to big energy, Chevron.
Okay, Chevron, an integrated energy giant.
The article says they're facing some headwinds at the moment. What kind of challenges?
Couple of things mentioned. First, that big deal they're trying to do, acquiring Hess. It's hit some snags.
Snags? Like what?
Apparently, Hess has partnerships with other energy companies, and that's creating complications for the acquisition. Regulatory hurdles or partner disputes, maybe?
Okay. Acquisition trouble. What else?
Geopolitics. Specifically, their operations or dealings in Venezuela. The political situation there adds a layer of uncertainty.
Right. Operating in politically sensitive regions can always be tricky for energy companies. Volatility, potential disruptions.
Exactly. And the market seems to be reacting to these things.
How so? Well, the article points to the dividend yield again. It's pushed it up to 5%.
5%. Okay, so that's definitely an attractive yield on the surface.
But does it signal risk? How does that 5% compare?
Well, compared to its main rival, ExxonMobil, it looks pretty good. ExxonMobil's yield is mentioned as being around 3.8%.
Okay, so over a full percentage point higher than ExxonMobil.
And even higher compared to the average energy stock yield, which the article puts around 3.1%. So, relatively speaking, Chevron's yield stands out right now.
But yield isn't everything, especially with those headwinds. What about the company's fundamentals? Its history?
That's where the article pivots. It really highlights Chevron's track record. Get this, 38 straight years of annual dividend increases.
38 years, wow. through all sorts of oil price cycles and market conditions.
Right. That speaks volumes about their financial discipline and commitment to the dividend. It's a very long streak.
And their financial health today. Can they handle these current issues, maybe even low oil prices if they happen?
The article suggests yes. It points to their balance sheet, specifically a low debt-to-equity ratio.
How low?
Around 0.15 times, which is considered very strong, especially in a capital-heavy industry like energy.
Okay, so low debt means they have financial firepower, flexibility.
Precisely. It gives them a cushion to navigate challenges, whether it's the Hess deal uncertainty, Venezuelan politics, or even commodity price swings, while still investing and, importantly, paying that dividend.
So the takeaway on Chevron seems to be, yes, there are current issues making headlines and pushing up the yield.
But you've got this long, impressive dividend history and a really solid balance sheet underneath it all.
Suggesting it could be an opportunity for someone with that long-term 10-year view the article mentions. Maybe buying a solid company while it's facing temporary concerns.
That seems to be the angle, a chance to lock in a high yield from a well-managed company, assuming you believe they can navigate the current turbulence.
Okay, makes sense. Let's move to our third and final stock, PepsiCo. Consumer staples giant.
Right. Drinks, snacks, very different from energy REITs.
The article says their growth has slowed down recently. They had a big surge after the pandemic, but now not so much.
Yeah, that post-pandemic period saw strong growth, but a lot of that was apparently driven by price increases due to inflation.
Ah, raising prices significantly.
Exactly. And you can only do that for so long, or inflation itself cools. So that price-led growth spurt has eased off.
Any other factors slowing them down?
The article also mentions some weakness specifically in the salty snack market right now. And PepsiCo is a huge player there, obviously, with Lay's, Doritos, Cheetos.
Right, a core market for them. And what about broader trends like health and wellness?
Yeah, that's mentioned too. The general push towards healthier foods and lifestyles puts pressure on companies selling traditional snacks and sugary drinks. It's an ongoing challenge for big food companies.
So slowing price growth, weakness in snacks, pressure from health trends. Sounds like a few challenges.
It does. But despite all that, the article highlights something interesting about the dividend.
What's that?
The yield. It's apparently historically high for PepsiCo, sitting around 3.8%.
3.8%. Historically high for them. That is interesting given the growth slowdown. Is it sustainable?
Well, this is where their history comes in again. PepsiCo is a dividend king.
Dividend king, meaning?
Meaning they've increased their dividend annually for at least 50 consecutive years. 5 decades.
50 years. Okay, that's even longer than Chevron's streak. That's incredible consistency.
It really is. It shows they've managed through all sorts of economic cycles, recessions, changing consumer tastes, and kept raising that payout. Gives you some confidence.
And are they just relying on that history, or are they actively trying to address the growth slowdown and health trends?
No, they seem to be making moves. The article points to acquisitions. They're buying up smaller, emerging brands.
Like what? Any examples?
Yeah, it mentions they bought Siete, which is a Mexican-American food brand. Think grain-free tortillas, that kind of thing.
Okay, tapping into that market.
And they're also trying to acquire Poppi, a beverage company known for its health-conscious sodas with prebiotics.
Ah, Poppi, right. So getting into faster-growing, maybe healthier categories through acquisitions.
Exactly. It's a strategy to tap into new growth areas and adapt to those changing consumer preferences, diversifying their portfolio beyond the traditional core.
So the picture for PepsiCo is growth has slowed from recent highs, facing some market pressures, but offering a historically attractive yield for the stock.
And crucially, they have that incredible Dividend King track record. Plus, they're actively trying to reignite growth by buying these newer, trendier brands.
It might take time for those acquisitions to really move the needle for such a huge company, though.
Probably. The article suggests it's a long-term play, but it shows they're not standing still. They're positioning for the future, even if the present looks a bit more moderate.
Okay, so 3 very different companies, 3 different stories. Let's quickly recap the core ideas.
Sure. WP Carey. The REIT that refocused its portfolio, took a temporary dividend hit but recovered, and now offers a high yield with potential growth from reinvestment.
Then Chevron, the energy major facing some current acquisition and geopolitical noise, leading to a high yield, but backed by a super long dividend growth streak and a strong balance sheet.
And finally, PepsiCo, the consumer staples dividend king whose growth has slowed, facing market shifts but offering a historically good yield, and actively acquiring brands to adapt and find new growth.
And the common thread, emphasized by the article, is that these are potential opportunities if you have that long-term perspective.
Right, 10 years or more. The idea is to look past maybe some short-term static and focus on the underlying business strength and dividend potential over the long haul.
It's not about timing the market perfectly, but about finding solid companies potentially offering good value for patient, income-focused investors.
Exactly. Less about reacting to today's headlines, more about the decade ahead.
So, a final thought perhaps for you listening. How do these specific situations, WP Carey's strategic pivot, Chevron's resilience despite headwinds, PepsiCo's adaptation fit with your own long-term goals?
Yeah, and what other digging might you want to do into their industries, their financials, before deciding if any of these align with your own investment strategy? Something to consider.
Definitely something to think about. That wraps up this deep dive. Thanks for tuning in.